Hi, welcome back. Today we will dive deeper into the cash flow statement, which can be a bit more challenging, and for that reason I will begin with a more conceptual presentation on what we're gonna do. So let's get right onto it. If you look at the screen, we've got the balance sheet here where all the assets accounts are going at the top, as we show it here inside of the rectangle, and then if we will move down to the lower section, we could see the total liabilities plus equity. Number one rule of the accounting principles is just everything has to be balancing out, right? Assets and liabilities plus equity. For us to calculate the cash movements, what we need to do is we need to calculate the difference between the total movements on the liabilities plus equity section minus the total movements on the asset section. And by movements I mean the total differences between the financial position on the balance sheet from one period to the other. So that's what we're gonna do today. Sorry, I'm just opening. Yeah, exactly, I need to open this up. And what we need to do is to also understand that the income statement is being developed in a very similar way as we will have to do it with the cash flow statement, because the income statement is nothing but the difference in movements or in financial position between the retained earnings account at one moment in time and the retained earnings account on another. So if we will import now for the cash flow statement all the movements that happened in those accounts from the balance sheets and the income statement between these periods, then we will be able to calculate all the figures. Let me take out one of the measures that we don't need here, and let's start to group some of the accounts. So we've got all the accounts imported here, right? They all have been loaded correctly. So we have it's called the net income, and we will recreate a cash flow statement by using the indirect approach. So from the income statement we will start to add back some of the non-cash items or some of the movements in operating activities that didn't have an impact on cash, or that we need to add that impact back. So if we will start doing that for all the accounts here, we will have the cash from operating activities, cash investing activities, boom, and then finally the cash from financing activities. As you could see, everything is very intuitive, is very Excel like, right? The way it feels, the way it operates. So just pay attention to some of the details on the cash flow statement, that many times, for example, on the fixed assets we've got the accumulated depreciation that we need to take out from there, and we also need to add back the depreciation on the operating activities, and some details like that any controller or any finance analyst or accountant at your company will be able to help. If it's not you, maybe you're the master here who's gonna take care of all of this. Just be aware you've got the tools here just as in Excel, so don't be afraid, jump onto it and you will get it done. See you on the next one.